So, why do you get stopped out of your trades? Why is the market, always, coming to you, hunt your stop loss and then hits it and then reverse back in your favor? Why, is this always happening to you? So that's what we'll cover in today's video. So first thing first, if this is the first time you're watching my video, my training video, hit the subscribe button below, just the link below. And stay up to date, whenever I publish a new video. So this way, you never miss, any trading tips, strategies, or techniques, that I share on a regular basis. So now back to our question. Why do you always get stop hunted? Well, couple of reasons why. First thing first. Let's say, for example, this one over here, the chart. Euro, yen, this market, generally it's in a range, between these highs and these lows, support, resistance. And the market, it's rallying higher, and you look at this, oh man, market is bullish, Look at this, huge bullish candle, The textbook says, this is a sign of strength, should go long, so you buy. And where do you put your stop loss? Well, maybe, you're not really trading with a proper position size, maybe you don't have much trading capital to start with, so you use, a fixed 30, 40 pips stop loss, or whichever that feels comfortable for your account size. So you enter over here, stop loss, you put it, say, somewhere about here. Maybe just somewhere here, stop loss, It's a decent size of stop loss. And the next thing you know, the market, reverse, boom, stop you out of a trade, and then rally backs in your favor. And then you ask the question, why? Why do I get stopped out? Well, because the first mistake that you're making is because your stop loss, is within the noise of the market. What do I mean by noise? So when I talk about noise, I don't mean, white noise or, noise, When I talk about noise, in trading, it means that you are putting your stop loss, within the normal ebb and flow of the market. So as you've seen earlier, let me just draw back those areas again, Area of resistance, area of support, These are another level that I can see. So this over here, that the market, this region between the 129.20 around here, okay, and around here, this is the normal ebb and flow of the market. It's just, flowing up and down between support, resistance. So if you're going to put your stop loss, smack in the middle of this zone, then you're pretty much asking for it, Asking the market to, hey, just hit my stop loss, I'm asking for it. Just give it to me. That's what you're doing, So this is what I mean by, you put your stop loss, within the noise of the market, Every market structure, they have their ebb and flow to it. You need to identify how the market flows, and get your stops, away from the noise of the market. Okay, so that's the first mistake traders make. Their stops is just, within the noise of the market. So second thing, why do traders get stop hunted, Because if you studied, textbooks, they tell you, whenever you buy, you should put your stop loss, below support, Or whenever you are short, Some traders ask me what is short, So short is the opposite of long, So when you're long, it means you buy and you sell at higher prices. When you short, it means that you sell right now, okay, and you cover that short trade at a lower prices to make a profit, So when you're short, textbooks, forums, websites, they tell you to put your stop loss, above resistance. And that is another problem in and itself, Let me explain why. With that, we can use the chart of a pound Aussie to illustrate my point. Okay, so pound Aussie, daily time frame. Okay, let me just get rid of this. So as you can see, So now, you know that you shouldn't put your stop loss, within the noise of the market. And the next thing you do, you put it, at obvious market structure. So again, textbook says, to put it just above the highs, just below the lows. Problem with this, see market rallies, consolidate, and then this candle starts to reverse, bearish engulfing pattern. Textbook says, okay, put your stop loss above the highs of resistance. So some of you put it above these highs, some put it above these highs. And then what happens? The market sweeps across the highs, triggering all this cluster of stop loss, Sweeps up above, and then continues lower. So traders who put their stops above here, have their stop loss eaten alive. Okay, and if you want to see another example, market comes down lower, okay, rally, Trader would see this and market bullish engulfing, right? At this demand area. Price is about to go higher. Let me go long. Let me buy. Let me buy. Stop loss, alright? Textbook says put it below the swing low or maybe below this area of support. Whatever the case is, market then swings down lower. Boom, right? And then rally back up higher again. So you can see that at this point, two things. Number one, don't put it within the noise of the market. And number two, don't put it right at obvious support resistance levels. These are, very obvious levels, right? Where if you put your stop loss, right, it's very easy to get triggered. Okay, so if you avoid these two mistakes, right, I would say, right, won't be 100% of the time. There's no guarantee in trading, but you will avoid, right, quite a number of trades, right, that would have, gotten you stopped out had you put at, this two trade location. So now brings me to the question, right, how do you set a proper stop loss? Okay, so my technique, my principle is very simple. Whenever you set a stop loss, right, it should be at a level, right, where if the price reaches that level, it invalidates your trading setup. And that level, right, should, right, be away from market structure. So let me just share with you two points, right? Number one, it should invalidate a level where if the price reaches it, invalidate your trading setup. And number two, right, it should be away from market structure. Away, right? We don't want to put it just above resistance or just below support. So let me share with you a few examples on how I go about setting my stop loss. So this is just for initial stop loss, right? After which the way you want to manage the trade and everything, right? It's outside the scope of today's lesson. First example, let's see what examples I've got for you. Okay, pound dollar. Let's have a look. So pound dollar. Okay, let's do. Okay, we already have some lines drawn over here. You can see that this market right over here, previous support, right? Support. And when the market breaks below support, right? Let me just go down to 4-hour time frame. Market breaks below this area of support. What does this area now becomes? Previous support becomes resistance, right? So now this is an area of resistance. So let's say you saw this market. Maybe it starts to consolidate, right? And you break down and think that, hey, this market, there's a good chance of it retesting back this low or even, breaking this swing low over here. So you want to go short. Where do you put your stop loss? Do you put it here? A or B? Or C? Okay, if it's me, right, I would usually have my stops, right, somewhere in the vicinity of C. Somewhere between B and C, right? Somewhere in between, right? I don't want to set it just above this highs because you know that if it's too close, the market can just swing up higher and then reverse down lower. So usually I put it, somewhere within this area. Okay, within this area, around the 1275 area where there is some buffer, right, above the market structure, above the swing high, above the resistance. So again, if you want to define, right, how much buffer you should give, you can use an indicator. So for those of you who have, followed me a while now, called the average true range. I usually use 20 period, but I'm not going to change this. The concept is the same. So this one, it tells you that the pound dollar on a 4-hour time frame, right, on average, it moves about 50 pips, right, every 4 hours. So what you can do is you find out what's this high over here, the value, and then you plus 15 pips, and that's your stop loss. Okay, so let's say this value, let's say is X, right? So X plus 50 pips, right? 50 pips. And this, let's say call it Y, right? That would be your stop loss, right, level. So that's how you can use the average true range indicator to give your stops some buffer to accommodate the noise in the market. So that's for pound dollar, one example, right? Let me move on and share with you another example. So again, this stop loss, right? It meets our requirement. Number one, it's at a level where if the price reach here, it would invalidate our trading setup, right? Because if you think about this, right, if the price rallies up, come to here, at this point, right, it invalidates our trading setup. You now have a price breaking out of resistance, right, and you even have a higher low, right? So this tells you that the sellers are no longer in control for now, momentarily. And number two, right, it's away from market structure. The market structure is over here. Our stop loss, right, is a distance away from it. So that meets our two criteria that we had earlier in setting your stop loss. Moving on, one more example. Okay, New Zealand Canadian. So if you look at this chart, I'll just zoom out a little. You can see that this market, right, it's somewhat respecting this downward trend line. Okay, and on top of it, you can see it's also at this area of previous support, right? Then act as resistance, resistance. So again, if you want to short this market on this time frame, right? I'm referring to this specific time frame, right? In all the examples I'm sharing with you, you can see that again. Let's say you think that the market is about to roll over lower, right? You want to go short. Say let's say you go short on the next candle open, for example. Let's say here. Okay, where do you? Okay, so let's say here. Where do you want to place your stop loss? A, B, or C? I hope by now, right, you are getting good at this already, right? I would usually, right, put it somewhere in the vicinity of C. Again, you can use the ATR indicator. Notice this one, the value has changed. It's about 70 pips, right, on the daily time frame. This market tends to move about 70 pips on the daily time frame. So what you can do is find out what's the high over here, plus 70 pips, and that is your initial stop loss. Because if you think about this, right, if the market could rally all the way up higher into this level, right, chances are this would seem now more of a trend continuation trade, right? Higher lows and higher high. And again, if the trend is against you, why do you still want to remain in this trade? Right? Clearly you are, or rather your analysis on this trade is wrong. So again, you can see that your stop loss is at a level where if the market reaches it, right, it would invalidate your trading setup. And number two, it's away from market structure. So just one final example, right, to nail home the point. So what was I looking at? I think this one was the 5-year. Okay, the 5-year. Same concept, right? You can see over here, market somewhat is in this area of resistance. So again, where do you put your stop loss, right? I think we just go straight to the point, right? Somewhere in this vicinity, right? Giving it some buffer away from this market structure. Because if the price can hit this level, chances are this could be a breakout of resistance. And hey, if you're short, right, you don't want to be holding your trade, right, into a breakout that's against you. Okay, so this again, right, if you're trading off the daily time frame, right, you want to follow these two criteria. So now let's talk a little bit about multiple time frames, a little bit more of a advanced topic that at one point or another, as your trading progresses, right, you would be trading off the different time frame, right, and still you want to apply the same concept, right, to your trading. So let's say on a 4-hour time frame, let's say you don't trade off the daily time frame, which is this one you see over here. Let's say you trade off the 4-hour time frame. Okay, and you zoom out a little and you notice that, hey, this market, let's say it comes down lower, right, and it consolidates, and then it breaks down of this area of support over here. So at this point, right, you don't necessarily have to now use this market structure to reference your stop loss, because number one, you're no longer trading on the daily time frame. You're trading off the 4-hour time frame. So whenever you set your stop loss, right, it has to be relative to the time frame you're trading. Imagine if you're trading off the 5 minutes time frame and setting your stop loss on a weekly time frame. Doesn't make sense because the stops on a weekly is too wide for the 5 minutes time frame. So it has to always be relative to the time frame you're trading. And let's say now on the 4-hour time frame, right, this price action develops, right, where you get pretty much a series of lower highs into support, price breaks down. So now the question is, where do you set your stop loss? All right, if you want, you can reference this black color, this area of resistance, market structure on a higher time frame. You can, or again, you can follow the same concept. Number one, you want to set it right at a level where it invalidates your trading setup. So what's the trading setup? In this case, if your trading setup is the descending triangle, right, you want to put it, say, somewhere about here. Okay, so if the market breaks down and goes back all the way up, right, you can see that this descending triangle, the setup is invalidated, because no descending triangle, right, looks like this, where the market goes down, comes up and break like this, right? The triangle is destroyed. Okay, so that meets our first criteria. Second criteria is again, right, away from market structure. So you can see that if, for example, okay, we draw this, okay, market breaks down, okay, let's say this is the downward trend line. Our stop loss is here, right? It's a distance away from this market structure as well, away from the downward trend line, as well as this swing high over here. So this meets our two criteria as well. Okay, so this is a little bit more advanced because we are now dealing with a lower time frame, right? And again, same thing, right? Whichever time frame you're trading on, right, it has to be relative. I mean, your stop loss, right, has to be relative to the time frame you're trading. All right, that's the point I'm trying to bring across over here. Okay, so with that said, right, I have come towards the end of today's video. I hope this helps you. You got some insight out of it, right, and prevents you from getting stopped out unnecessarily. So with that said, right, if you want to learn more about my trading strategy, techniques, methodology, right, you can just go down to my website, tradingwithrayner.com. I'll just put here, trading with Rayner. Okay, all this is just one word, right? tradingwithrayner.com, right? And just go down there. I got a couple of guides waiting for you. Ultimate guide to trend following, on how to write massive trends in the market, and the price action trading strategy guide, right? How to better time your entries, exits. We talk about support, resistance, and much more, right? So if you want these two guides, right, it's completely free. Just go down here, tradingwithrayner.com, right? Download it, and I'll send it to your email address for free. Okay, so with that said, I've come towards the end of this video, right? If you've enjoyed it, hit the thumbs up button, subscribe to my YouTube channel, and feedback, comments, questions, let me know below, and I'll be glad to help. So with that said, I'll talk to you soon.